We can go back, I guess, to Nixon, and then we can also go to Clinton. Kind of very different stories in terms of how the market performed during those periods of potential impeachment, and in the case of Clinton, obviously impeachment that did not result in him leaving office. What do you expect here if we actually end up at least going down this road of more and more questions and about the president's ability to hold on to the office?
Well, I think what a lot of guests have said to you today, and I would concur with this, is it really depends on what the economic fundamentals do from here. And if the pro-growth policies are in place, then it's probably not going to have a huge impact. In a way, for the markets, it could have a contrarian positive impact in that there was a lot of optimism in equities earlier in the year. That's been taken off, and this could be part of the reason why. So it's a little bit of a wall of worry. Now, if you look back at the Nixon time and the Clinton time, economically, things could not have been more different, right? And we're in the worst recession since World War II in 1974, the worst bear market since World War II in 1974, double-digit inflation. You contrast that with, in 1998, you had, at that point was about to be the longest expansion since World War II. That should sound familiar today. You had low inflation. And he had obviously had a very strong bull market as well. So the fundamentals today are probably closer to what you saw in 1998, although not as strong. So again, if it doesn't have a change in policy and sentiment remains a little bit subdued, it shouldn't derail the bull market too much.
Mike, I can't even tell you how much hate mail and hate tweets I got today for tweeting out that chart about Watergate.
Oh, yes.
And the point was, I mean, there is some historical precedent, and obviously the context matters, and what was happening with oil and
Sure.
geopolitics was completely different. So how do we think about those historical examples versus what we're looking at today?
Yeah, I mean, I think it's a secondary or tertiary factor here, and I think it only becomes very relevant if we're talking about a serious change of mood, a serious change of risk appetite by investors or CEOs, and societally, if it becomes kind of a bummer or feeds into some trends that maybe are going to jeopardize the expansion. I honestly think it's about that, because otherwise it would have to be a shock. If there was some kind of sudden moment where we said, oh no, the president's in jeopardy, policy's going to be upended, whatever it were, then it would be different than this kind of slow bleed process that we've been acclimated to for a while now.
James, you know, I think you're in the camp that says investors likely to tune this out. Is there a point at which they tune it in?
Well, I tell my clients you've got to ignore the circus and focus on the fundamentals. And to the great credit of your guests today, they've been saying to focus on the fundamentals. The historical pattern is that the markets often trade down when they're waiting for bad news from a special prosecutor's report or from the impeachment of Bill Clinton. But as soon as they find out what the worst of the bad news is, they trade up. The stock market went up 30% during the Clinton impeachment from the day of the Starr report to the day of the impeachment vote. The reason for that is that they'd seen the worst that could happen and decided that it wasn't a serious threat. Right now, I don't think the markets really perceive this as a serious threat, because if this is the worst that Mueller can come up with, campaign finance violations, it's probably not going to be something that's lethal to Trump's presidency, because Capitol Hill itself would be a ghost town if every member who was guilty of a campaign finance violation in some way was out of office. So the markets have been looking forward to the month of September and the month of October. They've been waiting for the Mueller report, the big pre-election report. So it's not like we didn't know something big was coming. And it's also not like we didn't know a major impeachment would probably be the focus of next year if the Democrats win a House majority. So I really don't see...
Ed. No, I'm sorry to cut you off. I just want to get a final word from Ed here on the confidence question, because that's really what that's how it filters into the economy and the markets. Consumer, business, investor. What will it take for that to change?
I think from here you have to look at the Fed. If for some reason, say, tariffs do lead to higher inflation expectations, and the modest Fed tightening cycle has to accelerate, then that's going to lead to the weakness in housing we've seen over the past couple of months could accelerate, business confidence could decline. And then as we get into next year, earnings growth is most likely going to slow down just because you're not going to get the nice year-over-year comparisons from tax cuts. So you could look at next year and say we could have a combination of things that could lead to that. But there's a lot that could go on between here and there.